Good day, everyone, and welcome to today's SOFTRAX Executive Webcast. Today's call is being recorded. At this time, for opening remarks and introductions, I would like to turn the call to the President and CEO of SOFTRAX, Mr. Robert O'Connor. Please go ahead, sir.
Well, thank you very much, and greetings, everyone. As many of you know, SOFTRAX is the leading provider of revenue management solutions to hundreds of corporations, many of whom join us on the webcast today. We do have several hundred registrants for this webcast, which indicates how much executives want to hear about today's topics from our distinguished speaker, backed by popular demand, Dr. Tony Sondhi, who will make his presentation entitled Update on Current Revenue Recognition Issues, and Tony will be drilling down on extended payment terms and concessions, and this is based on a lot of feedback that we've received from our audience about having Tony and other revenue recognition experts really drill down on a few topics, do a deep dive, as they say, and Tony will be available for questions at the conclusion of his prepared remarks today. Our audience consists of CEOs, CFOs, board members, venture capitalists, VPs, accountants, and other corporate and financial professionals. Let me just quickly take you through our agenda. All of this will be done by the top of the hour. I'll just spend a few minutes talking about SOFTRAX revenue management and how we fit into this topic today, and then turn it over to Tony for the majority of the program for his presentation. For those of you who are unfamiliar with our webcast format, we leave 10 to 15 minutes for you to ask questions after Tony's remarks, and again, all of this will be done by the top of the hour. If you're interested in asking questions, and again, we really do encourage them, if you look on your console, you'll see the Ask the Question feature, and please click on that and enter a question, and I'll be reading the questions throughout Tony's presentations. Either I'll interrupt him if it's appropriate, or more likely I will ask him at the end of his presentation. Now, the most commonly asked question is, can I get a copy of the slides? The answer is yes, and we make you work just a little to do that, and if you look at your screen, there's a 1-minute exercise that we ask you to do, and it is worth it. It gives us feedback. It is a questionnaire that provides us feedback, allows us to direct future programs, and again, today's webcast is evidence of that, as people have asked for Tony and others to do deep dives on certain topics. That will allow you to get the slides. You'll get an email link. You'll be able to get a rebroadcast of this if you want to listen later on or share it with someone. You need to complete the survey in order to get the CPE credits, CPA credit, I should say, and also that registers you as we will draw 10 lucky winners for the 2007 Revenue Recognition Guide, which Tony is the co-author of. So very important for you at the end of this to fill in the questionnaire. So in just a few minutes, let me just touch on who SOFTRAX is and why this is a very important topic for us, our audience, and our customers. SOFTRAX is an enterprise application company that focuses on revenue management software, and billions of dollars of revenue are managed through hundreds of customers. Throughout the U.S. and the world, as I said, hundreds of companies in many different industries use our software products to manage their revenue billing, revenue recognition, revenue reporting, and revenue forecasting. And as you may know, SOFTRAX started by serving the complex revenue recognition needs of software companies, and we're the clear leader in that market. And as you can see from this slide, we have grown to address the complex revenue needs for many other industries. In a recent study provided by RevenueRecognition.com and IDC, it was found that the existing financial systems of both public and private companies are not managing the revenue recognition processes, and that most public companies are still relying on spreadsheets and manual processes to manage critical revenue transactions. And however, this pressure has been heightened, as we all know, by ongoing regulation, whether it's the revenue recognition guidelines, as Tony will talk about today, or Sarbanes-Oxley. And here you see that the majority of public companies and almost 50% of private companies have recently had to change their revenue recognition policies. And as a result, the CFOs and other executives do not lack for challenges in today's highly regulated environment. They have operational challenges related to more complex business models, whether they're managing their contracts, the renewing of their subscriptions or renewals, whether they have an an on-demand business. In the middle of our slide here, whether they have to deal with compliance issues, as Tony will talk about today, in terms of revenue recognition guidelines, Sarbanes-Oxley or others. And certainly they have to show increased reporting capability, transparency, and visibility to make the right business decisions. And our solutions are closely aligned with these challenges. Our applications provide for improved efficiencies and increased revenues, enable compliance, whether it's revenue recognition compliance, expense recognition compliance, and also to help with visibility in terms of helping with strategic decisions that will improve business and corporate performance. And at a more detailed level, our applications allow for the broken out in terms of billing and operational applications that help with contract management, complex billing, renewals, and the whole recurring side of many businesses, a very deep and unparalleled revenue recognition and expense accounting applications, and business intelligence applications that allow for strategic insight that leads to better decisions. And these applications can be licensed sold as one suite or individually. And they are complemented by other applications and third-party applications to round out the suite if that's what people are looking for. And we have wrapped up all this functionality in really two major offerings, a complete billing and revenue management application for software companies, software as a service, business services, business process outsourcers, internet companies, information providers, and others, as you see on the screen. And very exciting news for us this week, we have released a new product that, for people who have already invested in enterprise applications such as SAP, Oracle, and Microsoft, revenue recognition for ERP application that allows for a real filling of a huge void where companies that are using these applications are still using spreadsheets, and this application allows for highly configurable, easily integrated application to those ERP applications. Again, taking our years of revenue recognition expertise and filling a void that exists in the ERP market. Our customers provide strong feedback for us in terms of greatly improved compliance with revenue recognition guidelines and Sarbanes-Oxley, large increases of productivity and efficiency with respect to all aspects of revenue, whether it's revenue recognition, forecasting, and improved customer relationships. So our mission is to help customers improve their revenue, reduce their costs, all the while complying with the guidelines that they have to in an ever-increasing regulatory environment. So what I'll do now is introduce Dr. Tony Sondhi and to give him the floor. Tony is, again, backed by popular demand. He is currently a member of the Emerging Issues Task Force of the Financial Accounting Standards Board, so EITF and FASB. He has been a member of the Global Financial Reporting Advocacy Committee. He has many other appointments throughout the financial world. He is the co-author of the 2006 and 2007 Revenue Recognition Guide. The 2007 guide has just been published in December, and again, we're offering 10 for those of you who will fill out the forms. And he has served on the board of directors of an investment advisory firm, advisor to many companies. He's a favorite of ours and a favorite of the audiences. With that introduction, Tony, welcome and good luck.
Thank you, Bob. I was going to say it's going to be hard to live up to. Appreciate it. And, okay, let's get to work in that case. As Bob has pointed out, we're going to discuss extended payment terms and, of course, the related issue of concessions. What I want to do is, to some extent, begin with a sort of a high-level argument about why extended payment terms are absolutely critical to keep in mind, and then we'll take a look at some detailed requirements as well. And I will point this out again later on, but I want to remind you that implementation guidance and accounting standards themselves are scarce in this area, which is why it's even more critical to be very careful about dealing with them. Now, let's begin then, and I want to start off by simply reminding you of one of the most fundamental things that we must keep in mind with respect to revenue. recognition, you all are quite aware, I'm sure, that today we recognize revenue in terms of the earnings process. And even more specifically, we're interested in answering two questions. And when we can answer those two questions, that's when we can recognize revenue. They're concerned with the amount and the timing. As far as the timing is concerned, the issue is when can you recognize revenue? With respect to the amount, the issue is how much can you recognize? Now, given that, please keep in mind, as I've pointed out here, and as Concept Statement 5 tells us, that we normally recognize revenue on completion of the earnings process, as well as assurance about the collectability of the amount that we're going to charge. And I'm sure that you're also aware that Concept Statement 5 tells us that you cannot recognize revenue until it's realized or realizable and earned, which has been effectively translated in terms of the implementation guidance into these four criteria that must be satisfied. And those are, I'm sure you're all quite familiar with them. We're going to focus on the third and the fourth. That is, the price should be fixed or determinable. The critical point there is that it ought not to be subject to refund or adjustment, and then collectability has to be reasonably assured. These are the two that we're going to be concerned with respect when we talk about or when we evaluate an arrangement with respect to extended payment terms. So let's look at what we mean by extended payment terms. Basically, the idea is a transaction where the vendor finances the customer's purchases in a sense because they agree to receive payments over an extended period rather than receiving, as very often happens, payment at the time of delivery with respect to products, and of course also very often with respect to services. And then I also want you to be very clear, very careful about this, because the issue also applies to intellectual property licenses and the amount of time that's allowed a customer or licensee to pay for the use of that license. And as always, the evaluation in terms of the appropriate revenue recognition method has to be made at the inception of the contract. And of course, there are other points in time where you have to think about that as well. But keep in mind that our primary evaluation in terms of the appropriate revenue recognition occurs at the inception of the contract. And at that point, what you want to do is keep in mind how or what the effect of the extended payment terms in that contract, what their impact is on revenue recognition. Of course, also we need to be aware of the fact that if extended payment terms are offered until the actual use of a product or service, or the resale, say, of a product by a distributor, for example, then what you might be facing is a consignment arrangement, which means you can't recognize revenue. But we're not really going to focus on consignment transactions here. We're thinking more, and we're going to discuss really extended payment terms in a contract where we can see products being delivered, services have to be delivered, or we're going to allow a customer to use an intellectual license. And as I pointed out before, with the exception of 97-2, U.S. GAAP does not really specifically address the impact of extended payment terms on revenue recognition. But I do want you to be aware, as I pointed out earlier just a moment ago, that we need to think about extended payment terms when we're analyzing service transactions, contract accounting issues, 81-1 type of transactions, and an intellectual license as well. So if the contracts are involved with, or they involve intellectual property, then you have to be aware of this as well. Now, extended payment terms, as I pointed out earlier, will affect, generally speaking, they may affect two of the four basic criteria. In other words, the fixed or determinable, and then the collectability is reasonably assured. Right? And it's at this point that we can take a look at some specific accounting issues. Bob, you have any comments at this point?
No, I just want to remind people that, to ask questions throughout this, for those of you who just got on the line, what you do is click on the question box and type a question in. I'll be looking at those throughout Tony's presentation. But otherwise, I'm fine.
Okay, great. Yeah, I just wanted to talk about that. Now let's take a look at specific issues, right? And then we'll talk about as I said, extended payment terms and their impact on specific issues with respect to revenue recognition. Let's begin with the point about fixed or determinable fees. Now, sometimes what happens in an arrangement with customers, either because of the way things are going, maybe because the customer expresses some dissatisfaction with the product and or the service, the vendor may agree to provide either additional products, and of course when I mean additional products, I'm talking about products that were not included in the original contract, or other services, and they may at times agree to a reduction in the arrangement fee. Other types of effects that you can see will occur with respect to concessions. Concessions would involve extending the term of the warranty, for example, permitting returns outside of the original arrangement, or maybe even outside of the master agreement that you have with that particular client. Or you might agree to either extend or change acceptance criteria in favor of the customer. So those are some of the types of things that you have to be careful about with respect to fixed or determinable fees. Now, the length of time with respect to collectibility, the point to watch out is the amount of time the customer is allowed to make payments. That's where you have to be careful with respect to extended payment terms. Now, of course, please keep in mind that if collectibility is not assured at the inception of the contract, then you cannot recognize revenue for that particular arrangement, which of course also means that you cannot recognize any receivables. Because in order to have those receivables, you need to have revenue. What some companies do is they'll recognize revenue and say, well, we know that it's not done yet, but what we'll do is we'll make it up or we'll adjust for it in terms of the bad debt expense that we have. And clearly, that's inappropriate as well, because the point is that you have not satisfied the criteria for revenue recognition. All four criteria have not been met, which means that either collectibility or collectibility is not assured, or the earnings process is not complete, or maybe both. So because those criteria are not satisfied, because collectibility and earnings process are in question, revenue can't be recognized, and you cannot simply adjust for that through the bad debt expense. Okay? Now, there are a couple of other things that I think you should also keep in mind, and that is there are certain other types of contracts that we have to be very careful about. Now, for example, the first one that I'd like you to think about is there are arrangements where the vendor or a contractor would permit a customer an extended period of time to pay. Now, let's assume for a moment that that is the normal practice with respect to that particular class of transactions. Well, if you're allowing a certain amount of time, if you're financing the customer's purchase, what you really have is both sales revenue as well as financing income. And you can't combine those two. You have to report those separately. There are specific accounting standards, APB 21, for example, that you must keep in mind when you have both sales and financing income. Another possibility is a multiple element arrangement where you're selling a product or service but you're also effectively providing some kind of a guarantee, financing or loan guarantee to the customer. Now, what that means is you've got a multiple element transaction. You've got the delivery of the product as well as the financing guarantee that you have, and which means that you must pay attention to FIN 45. The third possibility is where fails and you sell, for example, a product to a distributor, repurchase that at some point, or facilitate its sale to an end user by financing that end user, maybe even leasing that product to the end user. Now, there you have to meet very specific criteria, and I would recommend taking a look at EITF 95-4.
Tony, we have a few definition questions, if I could interrupt you for a second, just to make sure that people stay with you. When you mentioned the term implicit discount, if you could just define what you mean by that for our audience.
What I was talking about there is effectively what you've done is you're allowing customers a certain period of time to make payments. And it's the fact that payments are being made over time implies that there is an interest or financing component in it as well.
Okay. And again, another definition, when you just say extended payment terms, when does that come into play? 30, 60, 90, 180 days, just again from a definition perspective.
Actually, the best answer, which I know you're all going to love, is it depends. But of course, my task is to also clarify what it depends on. What it depends on, of course, is the type of arrangement itself. It's a function of what your normal practice is with respect to that particular product or service. And in terms of a specific definition of that, the only place where you're going to find it is in 97-2, SOP 97-2, on software revenue recognition. And we're going to see that in just a moment, but let me tell you about it. What it means is if you permit a customer to make payments, for example, after the end of the term, the license arrangement that you have, or for more than 12 months after the inception of the contract. So if a significant portion of payment occurs after that, then you effectively have an extended payment term. But don't forget the first 2 points, that is, it is specific to the transaction and it is specific to your practices, which brings us back to something that if you've attended any of these sessions before, you will remember from my comments on this issue. You need to have documentation. You need to keep good records of how you normally operate with respect to specific classes of transactions with particular types of customers. See, for example, you could have different terms for your end users than you do for your resellers, and that matters, but that you have to document. You must develop a history of that. That was a short definition.
That helps. I think that helps in terms of moving forward, and I know you're moving forward to SOP 97-2, which I think will clarify some other things. But keep the questions coming from the audience. Thank you.
Okay. So now we go into 97-2, and as I pointed out, here's the one place where we have for the lack of a better term, an extended discussion of this issue. Why does it matter with respect to software? The primary reason, of course, is that technological obsolescence. That is, you have a software version that you've sold. By the time you come up with the next version, payments might still be, the customer might still be liable for payments on the first one. That's where that technological obsolescence affects or raises the risk of permitting extended payment terms or concessions to the customer. Another possible reason, and a very common reason in software, is that it often doesn't really cost very much to produce an additional license, and sometimes or very often doesn't cost very much to provide that, distribute that additional copy or to allow a customer to add users, etc. And it's because of that you have to be careful, and that's why 97-2 pays attention to extended payment terms. And here's the point I made with respect to that last question that Bob had, and that is there's a presumption in a software transaction that the fee is not fixed and determinable when a significant portion of the payment is due beyond the earlier of the expiration of the license or 1 year. Now, I suspect that, and this is based on experience, that some of you are going to ask about the meaning of the term significant. You may have noticed that standard setters, and myself, unfortunately or otherwise, included in that, we're not always very good about explaining what we mean by significant. You see, it's sort of like materiality in that sense. And to some extent, there's a difference across accounting firms. They don't necessarily all think of significant with respect to this issue the same way. So you have to be very, very clear and understand that, what the practice is with respect to this particular presumption. Now, the other point that I want to be very careful about, and I want you to be very careful about, is that your evaluation of whether a fee is fixed or determinable is independent of the ability of the customer to make payments. You see, because what you're doing in one case, when you're looking at fixed or determinable, is you're thinking about how much am I going to charge this customer and what do I normally charge them and how much time do I allow them to pay me this amount for this specific set of services or products. Collectibility, on the other hand, is something totally different. It's concerned with the ability of the customer to make the payments. And you always make the evaluation about fixed or determinable and, of course, also about collectibility, two separate arguments, but you make your decision about those at the inception of the contract. The fact that you subsequently get payments, and even if you get a full payment in advance of what was agreed, but was considered at inception as an extended payment arrangement, even if you subsequently get paid earlier, is not going to change this conclusion, even if you have an expectation of that. So please be careful with that aspect of it, which therefore implies that a payment that is received after the end of a reporting period can only be considered revenue in the period that it is received. It can't be applied to an earlier time period. And you'll notice in the slides that I've also indicated the technical practice aids which apply to this issue. And you should certainly take a look at a carefully review of the different technical practice aids that I've specified here. Okay? Now, as I said, we're also going to spend a little bit of time looking at some of the technical practice aids in detail. Now, I can't imagine that anybody listening in here doesn't know about the technical practice aids, but I'll mention it anyway. These are implementation guidance provided by the Accounting Standards Executive Committee of the AICPA. And if you don't have them, you ought to go over to aicpa.org, and you can there find your way to the Accounting Standards Executive Committee, ACSEC, or simply in the search column just put in technical practice aids, and there you'll find the technical practice aids for software revenue recognition, among others. There are 6 volumes of these, somewhere in the neighborhood of 75 or 76 questions. I joined the ACSEC some years back. I served on it for 3 years. You can hold me responsible for the last 4 or 5 of those. I am not responsible for the earlier ones. Just kidding. But I just want to point out that you should take a look at the technical practice aids. So let's look at this one, 5100.57, which talks about overcoming the presumption of a concession. As I said, we've just talked about the argument that there's a presumption that it's not fixed or determinable if payment occurs or is permitted to occur after the expiration expiration or more than 12 months later. Now, of course, you can overcome that presumption if you have a history of actually collecting over a long period of time, and it's your practice to allow your customers a long period of time to pay. How do you get that history? What's the evidence that you need? Fundamentally, you have to be able to demonstrate timely collection of all payments under comparable arrangements. Now, before we go to the next slide, let me just spend a couple seconds more here. Notice the really critical terms here are evidence of a history. So you need documentation. What do you have to provide? That show that you were able to collect on a timely basis all the payments. So timely collection, then all the payments under comparable arrangements. We come back to my earlier point about documentation. You have to have a good record of doing this. Now let's take a look at what we mean by comparable arrangements. Customers, type and class, which in other words means that you ought to look at resellers separately from end users, let's say. There may be a difference between those. You ought to look at volume users versus single users. You ought to be careful about the type of product you have. What version is it? There may even be differences in platforms, and there might be differences in payment terms across platforms. You have to be careful about the substance of the transactions. What are the payment terms? What are the economics of the transaction which you enter into with different types of customers? So developing this history, documenting this, in order to document it appropriately, you have to keep all of these things in mind. Now, if you cannot overcome the presumption, you don't have sufficient history, or you have a spotty history, in that case you can't recognize revenues until they become due. So it's at that point that you recognize them. Early payments that are made sometimes by customers, those would also be recognized upon receipt, right? So please keep that particular argument in mind as well. Now, of course, what happens, and this is a fairly common question that I've come up against. My clients often ask, what if we transfer the rights to receive payments to an independent third party without recourse to us? Well, the problem is that what you've done is entered into an arrangement about the receivables. But at the same time, you haven't changed the substance of the transaction between yourself and your customer. If you don't change that, you haven't changed the accounting requirements.
Tony, would the same be said? We had one question about letters of credit and guarantees and things like that. So if they have guaranteed letters of credits, does that fall under the same answer for that?
Well, Bob, it matters as to who has provided that letter. If the vendor is involved in that letter, then we'd have to be more careful about it. I mean, if the customer gets a letter of credit from a bank, that's a different issue.
Yeah, letter of credit with an established bank was the specific question.
Yeah, that's the step, because the vendor is not providing any guarantees. Right? The thing we would be concerned, because we're talking about the accounting from the perspective of the vendor.
Right.
That's the distinction to keep in mind.
Okay.
Some examples of concessions. Now, these are, of course, derived from 5156, another technical practice aid. But let me clarify one thing. This is not meant to be an exhaustive list. Right? So it's not something, you don't have something you can tick off and say, well, I don't have this or I have this. Not that kind of thing. You have to evaluate the substance of the arrangement you've made with your customers. But let's take a look at them anyway. Concessions that you might provide, if you change the amount of the total arrangement fee that you had, reduce it, for example, that you have a problem with. That would easily be a concession. If you increase the deliverables, or you allow the customers rights that are not included in the original transaction, financing fees that the vendor if you accept returns that you would not under the original contract, that would also qualify as a concession. Now, some other possibilities, and these are, of course, some of them may be more specific or only relate to software, such as post-contract support, upgrades, other services, or maybe even licenses. So if you were, for example, selling a particular product and service to a customer, but you have other products and services as well, and if you allow the customer access to, say, another type of software that's not included in the original contract, again, that's a concession as well. Now, this is something which I've noticed in the last year and a half or so, to an increasing extent. What's happening is, particularly with software companies where significant customization, modification is required after the customer acquires the license. In other words, what happens is that you end up in SOP 81-1 because it's a contract accounting issue. And there, you have to be very careful because you have a software license, you have significant customization, which so that part of it falls into 81-1, and then you find, or you also have post-contract support. But post-contract support remains an SOP 97-2 deliverable. So what you might find is that while you're providing the customization, if it takes you longer, you effectively end up, say, as a concession, giving the customer additional post-contract support. So if they were entitled to, say, 12 months of it, you throw in an additional 3 months. That's a concession. For term licenses, for example, if you extend the time frame that you allow the reseller to sell to an end user before they have to pay you, or if you extend the amount of time that you allow the end user the license or the use of the license. For certain limited licenses, one example of a concession would be allowing the reseller to sell in geographic areas that were not included in the original contract, or in a number of locations in which an end user is permitted to use the software. Now, of course, if you increase the deliverables, one of the examples I used earlier, but at the same time charge the customer an additional amount. See, for example, if you go from 12 months BCS to 15 months BCS, but then you charge them an appropriately larger amount, that would be perfectly fine. That would not be a concession. But please keep in mind that when you're increasing that, the amount that you're charging really has to be appropriate, because you don't want to affect the VSOE that you have on your post-contract support. Now, or for example, if you had certain obligations which were eliminated without having to refund cash to the customer, right? In that case, you haven't given anything up and therefore would not qualify as a concession either. Now, we think a little bit about customer financing. The question there is, does the vendor's participation in the financing result in incremental risk? You see, because the point is that at the inception of the contract, you have to think about the amount of the risk, how much of it is being transferred to the customer, how much do you keep, how does that affect the amount of revenue you've recognized. If you participate in the customer's financing such that the vendor's risks are increased, then you effectively have provided a concession, and that would affect your ability to recognize revenue. Now let's take a look at that in a little bit more detail. Some indicators of incremental risk. If you provide indemnification for the financing that goes beyond what was agreed to in the contract. You see, because if it's in the contract, the presumption is that you've been appropriately compensated for it. But now you're adding indemnification. That would create a problem. Written customer acceptance beyond that which you've already received. In the event of a customer default, if the vendor is obligated to take certain actions which are going to increase its costs, against the customer on behalf of the financing party, which basically means that the vendor is still responsible, has additional risk, in other words. There are additional prohibitions and limitations on the ability of the vendor to sell other products and services to the customer, same problem. Because now what happens is what you're saying is you're prevented, the vendor is prevented from additional transactions with that customer until payment is made on the original contract, therefore incremental risk. Then we take a look at a couple of others, three others actually. For example, certain kinds of guarantees that have to be provided. And without those guarantees, the customer would not be able to borrow money. The vendor has taken on additional risk. If, for example, the vendor has provided concessions either to the financing party or to the customers. This, by the way, although we're talking about this in terms of software revenue recognition and contracting, etc., this is something that has a fairly direct relationship to an issue that's very much in the news today, and that is all these securitizations that were done by subprime lenders in the housing market. So, that also where the question was whether the incremental risk taken on by one of those parties was correctly accounted for. Or provisions that lead to a vendor's guarantee of the customer's indebtedness to the financing party. So in other words, the vendor guarantees some of the debt, which means you have incremental risk. Okay? Then there are some examples which do not qualify as incremental risk for the vendor. Introducing the customer, facilitating the discussion, that doesn't qualify. Okay, that you haven't taken on any additional risk. In other words, you're still letting the bank or the financing entity make the decision on the basis of the customer's creditworthiness. If you represent to the customer everything that represent to the financing entity, everything that you have included in the arrangement, you're not offering any additional services or taking on any additional risk. Any actions that are explicitly authorized by the customer to terminate the licensing arrangement, for example, inclusion of any recourse provisions that were not in the original contract, again, same argument. Those would not qualify. Okay. Again, please keep in mind that your analysis of whether you overcome the presumption has to be made in terms of both paragraph 97-2 that we've talked about, or paragraph 28 of 97-2, and the technical practice aid that we discussed earlier, and specifically 5157. Right, so in that case, if you can overcome it, you may still have a guarantee, but that means you have multiple element arrangement. You have to account for the sales transaction as well as the guarantee. In order to account for the guarantee, you go to FIN 45 and determine what the proper accounting and the appropriate accounting is for that guarantee. And also I would recommend that when you have such guarantees that fall under FIN 45, please take a look at 3 related EITFs as well that talk about the effect of FIN 45 on certain revenue transactions. And these are, of course, I thought that would be more detailed than we would have time for, and so I've left them out, but you can find them, of course, in the Revenue Recognition Guide, the discussions. Okay. Now, with respect to I just wanted to make a few comments about contract accounting. As I said earlier, please keep in mind that software transactions where there's significant customization, modification, those can fall into contract accounting, or in other words, you have to apply SOP 81-1. Now, the problem there is that if you do allow extended payment terms or concessions that are outside the original contract, one possibility is that you're going to end up with unbilled receivables. That, by the way, is something, the unbilled receivables account, you ought to be extremely careful about, manage it very, very carefully, and that ought to be managed at the highest levels in the company. I think the CFO should always be aware of what's happening to unbilled receivables, how that's changing. And of course, the real problem is that it may end up affecting your ability to apply contract accounting, because remember, the fundamental principle there is that you have to be able to develop reasonable and reliable estimates of three things: the total revenue, the total cost, and the degree of completion, the estimate, the progress towards completion. So now, if you have a problem with unbilled receivables, or the fee is not fixed or determinable, that sort of takes out your ability to develop reasonable, reliable estimates of revenue. And that is going to have a significant impact on the amount and timing of your revenue recognition. Now, sometimes what happens is that the customer may dispute services that were rendered, may refuse to make payments, or the vendor, in face of that, the contractor in this case, may effectively make concessions with respect to either the fee, the amount of work to be performed, or may even offer to perform more services. And once again, what's happening is that by extending the amount, you may effectively have an impact on your ability to say that you can still apply 81-1. Right? So, which means, from a contract accounting perspective, some of the most critical elements are: you have to analyze the terms of the agreement, the nature of the services being offered or being provided under that agreement, and you have to document your history of granting concessions or refunds. And I cannot overstate the importance of it. You have to be extremely careful documenting concessions with respect to contract accounting. So that takes care of my remarks, and what do you think of that timing, Bob?
Well, I'm just trying to work through about 100 questions here, so I'm trying to organize them as you spoke and trying to get the biggest bang for our buck, so let's get going here, and I'll do my best. Certainly, Tony, many of our customers and people we talk to have international businesses and do worldwide business. And it's certainly more the norm for extended payment terms to international customers. Any thoughts on, is that, again, what the practice is for international business without jeopardizing revenue recognition when you use a good deal for your percentage of business outside the U.S.? So can you offer some insight into extended payment terms granted to international customers?
Yes. The first thing is that initially, when you start doing that, start selling abroad, you might not have a significant amount of customers. But what I would do is start documenting and classifying them separately, because there are enough other contractual differences, and payment is just one of them. Sometimes in international transactions, even delivery and passage of title is considered very differently. So, for example, in some countries, the title doesn't pass until all payments are completed. So you do have to be extremely careful about that. But the simplest answer to response to that is to set up a different class of customers and document them separately, so it won't affect what you're doing domestically. And then you may find, as your business grows, that there are differences across regions. Asian countries in one, for example, bucket, if you wish, and the European customers in a different bucket. And even among European customers, you might find, the emerging markets over there, you need to do it differently. So you can document that. It doesn't necessarily affect revenue recognition.
And while we're on that topic, a similar topic, a lot of our customers, again, have a sell-through model and are dealing through resellers or distributors, and if they have firm payment terms with resellers, and the resellers are guaranteeing payment, how does that affect things in terms of that type of business model with respect to extended payment terms that might be being offered to the customer?
several points in there, and I'm going to try and get hopefully get to all of them that I thought I saw. And the first point is that, as I pointed out earlier, you can certainly segregate resellers from end users. And in many cases, I think that does work out that way. In other words, you have different terms with resellers than you do with end users. Having said that, it's also possible that with respect to end users, your normal practice may be extended payment terms, whereas it may not be with end users. And if that's the case, again, separate documentation will help. The point that I think the issue to be very careful about with resellers is, what kinds of terms do you have? If they don't sell within a certain period of time, what are your responsibilities and so on? You have to be extremely careful with those terms. I would spell them out very carefully in the master agreement. I would be extremely careful in applying them appropriately, because channel stuffing, as you, I'm sure have heard, creates lots of problems. Restocking sometimes can appear to be that way, so you have to be very careful with both the initial agreement that you have with your resellers and what your normal practice is with the resellers. And again, if you find that your normal practice is sort of moving in a direction away from what your contracts are, right there I would recommend then renegotiating, working on those contracts, because you want to make sure that these don't appear or don't start all of a sudden grow into concessions and extended payment terms.
Okay, Tony, a lot of questions on collectability, as you might imagine, and let's get to them. So would collectability be defined, let's assume that you're offering extended payment terms, do you have to determine the creditworthiness of the customer over the life of the payments, or just at the inception of the contract? Does that make sense?
Yeah. Actually, the answer is you have to do both, because you must, at the inception of the contract, assure that payments will occur on a timely basis. The other point, though, is that as time goes on, you can't have slippage either. Right? So the analysis of that is done throughout the term of the contract. You can't just leave it at one.
Okay, and if collectability is an issue and therefore revenue is in jeopardy, is it also unacceptable to record a receivable and unearned revenue?
If it is at the inception...
Right, that's the question.
Yeah, then
right up front they know collectability is an issue.
Then you have a serious problem. Then you can't recognize it.
Well, but how about the receivable and the unearned revenue is the question.
Yeah, I guess maybe I'm a purist on that. I think you have a receivable only when you have revenue. So they go hand in hand. I'm always leery about things called unbilled receivables and stuff like that. You have to be very careful of the circumstances under which. But if you can't recognize revenue, then you shouldn't be putting in.
Okay. More collectability. If, and I don't know if this is an exact statistic or whether it's just for exaggeration purposes, but if we only collect 99% of our payments under extended payment terms over the past X number of years, would that disqualify us from recognizing revenue up front on all future deals? So perhaps tongue-in-cheek about only 99% of payments. Maybe not, I'm not sure, but would that disqualify them from recognizing upfront revenue on future contracts?
You have to be careful there about slippage into, when does it go from 99 to 98 to 97, things like that. That's one point. Generally speaking, if you have that much of a collection, then I would ask what the normal uncollectability is in that particular industry, what's your experience in that, and so on. So it seems to me well within the bounds of normal business practice. But that's where you have to, that's where the evaluation comes in, where the judgment comes in. Are you experiencing the absence of collections or a decrease in collections, or is it really just your normal uncollectible experience?
Okay, we can't get through a revenue recognition webinar without talking about VSOE, at least in some cases, I'm sure. And there's lots of questions about the relationship between extended payments and VSOE. And so, for one here, if a transaction has extended payment terms, and that creates a multiple element arrangement, is there any way to document VSOE, or perhaps even a broader question about clarifying the relationship here as VSOE plays into this extended payment term issue?
Right. The first point is that if the extended payment terms are normal business practice with either all customers or only with a specific class of customers, then you don't have a VSOE problem. I mean, what you do have to do is document the fact that you're allowing that much of that period of time to pay, and that you're collecting on time. But that becomes your VSOE then. That the actual term and the fact that you're collecting on the basis of that arrangement, then it's perfectly fine. Now, it's when you slip into extended payment terms or you allow concessions, that's when you have to worry about it affecting existing VSOE. It's that slippage that matters, not if it's standard business practice.
Okay. Quite a few questions, as a lot of our customers do defer costs in addition to revenue, whether it's under 81.1 or otherwise. A specific question, if we're applying extended payment terms in an 81.1 arrangement, can we also defer the related costs? Or the related expenses that are associated with that revenue is how I read into that, Tony.
Yeah, that's a tricky one. I'm going to have to be very, very careful about the answer. The first point to keep in mind is that in general it's hard to defer costs. Certain costs just can never be deferred. Where you're permitted to defer, those are direct and incremental costs. So that's a principle that applies in most places. I'm a little bit concerned about deferral and contract accounting, because you have to be very, very careful about that. Now, of course, if you're doing completed contract, then you're only going to recognize stuff at the end of the contract. But there, you'd have to be even more careful about extended payment terms, because once the contract is complete, what's your standard business practice? How much time do you allow customers to pay? But I would be careful about the deferral. So you need to. I'd have to look at the actual contractual terms and so on.
Okay, we are up against the clock, Tony. Thank you very much. I thank everybody for their participation, and again, we had about 100-some-odd questions, so I apologize for only getting through some of them. Again, thank you to Tony for your expertise. I think it was great to do a deep dive on a couple topics, and certainly by the attendance and the questions, certainly I think it was worth it for everyone. I will remind people, as your screen says now, that we would ask you to fill out the survey. It will really take about a minute. It does give us a lot of input for future webcasts such as this. It will allow you to get the slides, the presentation slides. It allows you to get one CPE credit, and there will be a drawing for 10 people from this group that fills out the survey to get the 2007 Revenue Recognition Guide, of which Tony is one of the co-authors. Thank you again. Please look at our webcast, your email, and our websites, at SOFTRAX.com and